This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
But even if mortgage rates fall a percentage point from today, it's still going to be here. And even if they fall 2 percentage points, so down to 5%, there would still be some type of lock-in effect for the next decade. So there's going to be a lot fewer existing home sales than there would have been had the pandemic and all the policies and everything that happened during the pandemic not occurred.
It's just staggering. It's a very different kind of world nowadays, folks, because of these long-term fixed rate, 30-year mortgages. So, Lance, one of the counterintuitive things that I've been saying is that, and this is what people have not understood very well, is that most people think, and they're right in most scenarios in the past, right? If you look at history and you say, hey, rates have gone way up, affordability has gone way down, that's going to crash the market. But what they didn't consider is all of the existing mortgages that literally became more valuable as rates went up. Because when the delta gets bigger, that existing mortgage at the low rate becomes even more valuable to the person who has it.
Yeah.
And this is something people have not understood very well. I've been beating the drum for a couple of years. And the people who got it wrong are the ones that said, hey, here's the experience a new home buyer has coming into the elevated interest rate market. We have elevated prices, elevated rates. They can't afford it. It's tragic for them. But what they didn't really think about is how it was for all of the existing people, which is 130 million plus houses. Well, a lot of them didn't have mortgages at all, so that's not accurate. But 60% of them do have mortgages, and assuming a large percentage of those have the low rate mortgages. That's the component that mattered, because that's where most of the inventory would have come from if we didn't have the lock-in effect.
In terms of like that piece of it, Morgan Stanley, they've named it this phenomenon, which is last cycle, the homeowners were essentially the weak hands, right? There were so many people in that pool that had distress that, they shouldn't have been in the pool, right? They were given mortgages they shouldn't have had.
Right.
Also, some of their payments rose over time. And so they were the weaker hands. This cycle, Morgan Stanley says that the homeowners are the stronger hands.
Yeah.
It's different lending. They got these fixed rates, 2-3%. Last cycle, there was a lot of people who would just walk away, hand the keys back in. It was cheaper for them to go rent than pay on that mortgage that was under.
And now it's cheaper to keep your mortgage and it's more expensive to go rent, which is, right.
If I left here and had to go rent something, I would get something much smaller and pay more. It's a different cycle. And, you can't just take what happened the last cycle and say it's going to happen this cycle, because at the end of the day, to move house prices down, you need a lot of supply, and you need a particular type of supply, which is they are selling and they are not buying something else. So even if the lock-in effect were to ease up, let's say mortgage rates come down, the people who would be unlocked are people who have 2, 3, 4% mortgage rates who'd be like, you know what, they've come down to 5. That's low enough. I've had another kid. I'm moving on with my life. I'm selling. I'm buying something else, right?
Yeah, right.
When they sell, they're going to go buy. They're a seller and a buyer.
I'm so glad you mentioned that, because then that does not increase inventory, right?
Yes.
It's a trade. And these people, the things you didn't mention is, number one, those people have a lot of equity, number one. And number two, they were underwritten under very strict mortgage underwriting guidelines, and they have fantastic credit. You look at the credit scores of the existing mortgage pool out there, and these people it's the complete opposite of distress.
And what's going to happen to a good number of those homes is they are going to become accidental landlords, where they're just the new cohort of accidental landlords.
Right.
Some of the people are 2-3%. They're going to realize that their mortgages were actually assets.
Yep.
And we'll get into it. Some of them will like it. Some of them realize they got in over their heads.
Yep.
But we will see some of that. But that going back to that point of why the type of supply matters is the last cycle, that cascading drop in home prices was because there was a lot of people who were foreclosing or short selling or walking away And that was just supply, right? They did not re-enter the market to buy. They were going to rent. They were going to live with relatives, roommates. Like it was just very different dynamics.
Yeah, very different dynamic. And Lance has highlighted a comment here from the FHFA report that says, absent a dramatic decrease in mortgage rates, it looks like the lock-in effect could be with us for a long time. And I completely agree. Before we get to the commission lawsuit and the changes in the real estate industry, the one thing I would like you to address is rents, because we also have a strange dynamic in the rental market. And of course, our listeners are investors. They'd love to see rents go up, but rents have kind of stagnated. And I'd say that there's maybe, I don't know the number, but it's just anecdotal, but 15%, 20% of the renter pool that could kind of go either way. Most of them, of course, they'd rather have a single family home, but if the deal is good enough, they'll take an apartment. And the apartment market is so oversupplied now, and it is weighing on the would-be rent increases that we might otherwise see because the overlap of the single family to apartment market. And the apartment market's going to take, the multifamily housing market's going to take a couple years to recover. So I think we are unfortunately seeing some of the results of the multifamily housing market affecting the single family market to a small degree, but it's there. Your thoughts?
Exactly. So the weakness in the market, especially in residential, is the multifamily stuff, where there was a lot of projects that were under the works that were out there, and there was a lot more that were financed when rates were ultra low. And as those move through the pipeline and that goes out there, it's creating and will probably create more weakness. Now, the thing that matters for single family is that a lot of that multifamily that's under construction is in certain areas and in certain markets, right? A lot of the boom towns like Phoenix and Nashville and Austin are seeing the most, and they've seen more of the weakness in terms of multifamily rents. This is Zillow data, and this is whole year over year. So peak to trough, some of these can actually be a little, like Austin is down 3.5% year over year.
Yeah, that's 3.5% in rents.
Yeah, for just multi. Now, peak to trough, they're actually down 7% because from the top reading of 2022, but I don't want to get into that too much. But so multi has seen more weakness than single, and single has seen a deceleration and has seen more weakness in the boom towns where there is a lot of that multifamily supply, but single family is holding up much better than multi.
Yeah, I agree. I do think the multifamily is starting to affect it a little bit, though.
Yeah, and so I think where it matters the most for single family is if your property that you're investing in is in an area where your type of renter is in direct competition with that type of single family home. That's when it matters, right? Because if the rents are falling on the multi side, they're offering a lot of incentives and stuff like that, and that's enticing your type of renter, that's where it probably has more of an impact on you.
Yeah. So let me just read off a couple of the numbers here because we are still up and making nice gains on rents. They're just not as great as they used to be. So 2021, I'm just looking at overall US single family home rents up a whopping 13%. That's incredible. And 2022, 8.5%. And then 2023 moderating, but still very good at 4.6%. So
all things considered, especially.
Yeah. Very, very solid rent increases. I mean, for 20 years, I've been telling people the goal is to raise rents 4% annually. So we're ahead of that still. But again, everybody in their mind does the compared to what? And they get spoiled, right? It's not as good as it used to be. That's just the reality of it. But Lance, talk to us a little bit about where this rental data comes from, because I have never found single family rental data to be that great. On apartments, they survey these, John Burns and all the rest of them, right? They survey big apartment owners and it's pretty easy to get the data. Single family is much harder.
Actually the way that I like to track single family, and I do this Zillow data, which I like the Zillow data, but I also like to just read through the earnings reports of the institutional players, Invitation Homes, American Homes for Rent. Yeah, they of course play different than the mom and pop landlord types. Yep. But how I track rents is I look at the multifamily data from Zillow. I look at the single family data from Zillow. And then I like to look through the earnings reports of like Invitation Homes and American Homes for Rent. Because one thing about Invitation and American Homes for Rent is that they buy the same type of homes, and then the homes in the portfolio are the same. So
Mhm.
what I don't like as much are some of the listing sites, and I don't want to name names, that put out rent reports, but some of theirs get skewed by mix shift, right? Like if what's on the market for rent is
Yeah.
changes,
Yeah.
then that's going to throw those numbers all over the place. So I've found that the Zillow numbers tend to be a little like they're less volatile.
Mhm.
And then I like those Invitation and American Homes for Rent because I know it's the same group of homes.
Yeah, and we didn't used to have that because they weren't really that significant in terms of, institutional players in the market. And they weren't years ago, they weren't public, they didn't publish data like they do now and all that kind of stuff. So that really is handy to have. And they are much better at raising rents than mom and pop landlords are. So their presence in the single family home market pushes rent comps up. So I think investors ought to just be happy the institutional players are here. And a lot of people complain about them and say they're crappy landlords too. So you can provide a better experience as a mom and pop investor. So that's going to be good for you.
Now, I don't know if we want to get into the institutional side too much, but I have a lot of data there as
Yeah,
well.
yeah, a little
And
bit. Just touch on it for us.
what we've essentially seen there is that during the pandemic housing boom, during that frenzy and liquidity was sloshing around everywhere, there was a good amount of an uplift in the institutional buying, but really things have gotten a lot more constrained since then. This is Tricon, which last quarter Blackstone just bought. This is Invitation Homes. Same thing, went up a lot during the pandemic frenzy and then came down. You see this real big spike up there in 2023. That is because of the multifamily and office stress for Starwood, that Starwood offloaded 1,900 homes to Invitation Homes.
Because of the stress they had with their office properties.
Yes,
Right?
exactly.
So,
Yeah, I'm reading that. That's my view based on all the
right.
earnings reports that I've read.
And that's a very reasonable view. And I'm glad you mentioned that because sometimes a seller, even a mom and pop seller, becomes distressed not because of the good properties they have in their portfolio. Those are performing great, but they have some other stressor in their life or their portfolio that causes them to need to sell the good asset, right? And so that's a very good point.
Yeah, and that goes to the economy at large right now too, where homeowners themselves are in a fairly good spot. So the stress that's getting added and the homeowners who could get in trouble, it's probably on their credit card side or other stuff like that, whereas it's not like directly the mortgage debt. This
Right. Yeah, I agree. I agree. And they have an awful lot of equity. Anything else on the institutional before we just talk about the industry to wrap it up?
I think one more thing to show, because it's really hard to find this, and this is actually something I only give to my premium audience, but I'll share it here. I went around.
I talked about this on my show. Yeah, it's a great chart. Yeah.
Yeah, so I went around to everybody, and I went to Fannie Mae, went to Freddie Mac, Morgan Stanley, Goldman Sachs. Not everybody answered, but I got 11 research firms to give me their estimate whether the U.S. housing market is underbuilt or overbuilt. And of all of these, it comes out to an average of like 2.8 million underbuilt.
Underbuilt.
Underbuilt, yeah. So Zonda's the lowest at a million estimate underbuilt.
That's
Fannie
the shortage.
is 4.4 million for underbuilt. And then the interesting one is like Realtor.com, where they think that the US housing market is underbuilt by 2.3 million units, but they think that single family is underbuilt by like 5 million and that multi is overbuilt, which is kind of interesting.
Yeah.
But generally speaking, if you look through a lot of the numbers in these reports, most of them think that most of the underbuilding is on the single family side.
That's interesting. So all of these 11 major firms, Fannie Mae, Zillow, et cetera, Realtor.com, Zonda, which is a real estate research market software and so forth, JP Morgan, Morgan Stanley, National Association of Realtors, Freddie Mac, Bank of America, Zillow, they all think the US housing market has a shortage. It is underbuilt by between 1 million and 4.4 million homes. Zonda is the outlier, really. Their estimate's very low. So this bodes well for investors who are in the market and are buying now because.
And one thing that I did here with this analysis is I only included their conservative estimates. So like Morgan Stanley, you see there, they think the US housing market is underbuilt by 2 million homes. That's their conservative estimate. Their aggressive model thinks that we're underbuilt by up to 6 million.
Wow.
Yeah.
I wish you would do a chart on the aggressive model, maybe comparison with two different colors. That would be a good one for you. Lance, do you want to talk about the industry? I mean, with this big change in the NAR settlement and, these real estate firms and the class action lawsuits over commissions and so forth a little bit, and, what changes that might mean?
Yeah, before we get into it, though, I just want to make a point, which is U.S. housing market, his affordability has gotten strained. And so a lot of would-be home buyers can't afford to buy. And a lot of homeowners who would like to sell and go buy something else, they can't afford it either. And so resale transactions are fairly low in the market right now. And I think what that creates is a good amount of angst where, politicians are probably feeling the pressure. And the thing about housing is that housing affordability is not easy to fix, right? It's a hard problem to fix. But what is very easy is scapegoating. And that's one thing politicians love to do. And so I think what we're going to see a lot of over the next 6 months is probably some scapegoating at the housing sector at different stakeholders, whether it's Airbnb host, whether it's single family landlords, homeowners themselves, real estate agents, institutional, exactly. So we're going to see a lot of that. Now, what's happening on the real estate agent side with DOJ going after the National Association of Realtors and all these lawsuits, this is kind of like a multi-decade thing where there's been a feeling among some economists and different actors within the real estate that the commissions in the United States are too high. And so I think that's what this is. And it's just kind of come to a critical tension point. So with the proposed NAR settlement, I think one thing we've already seen is a ton of misinformation by the media, because the reason is they don't understand, right? And some of that is because they haven't paid enough attention. And the other part is nobody really knows quite how this is all going to shake out, right? It could be a multi-decade thing. And, JP Morgan put out an estimate this week. They think that commissions over several years will fall 30%. It'll increase existing home sales and turnover by 7%.
Why will it increase turnover? That's interesting.
Because sellers and homeowners would have lower switching cost.
Oh, okay. Yeah, the transaction costs are pretty high. So that would make the market possibly more liquid, kind of like discount brokers in the stock market, where basically you can now trade for free pretty much, probably brought more people into the market. Right?
Exactly. So that's the thinking there. Now, that doesn't mean that. So, if that even occurs, that still would not make up for all of the switching cost that have gone the opposite direction because of the lock-in effect. Because switching costs are actually, historically high right now because of the lock-in effect. Yep. People giving up 2-3% mortgage rates and what that new mortgage would cost at 7%. But yeah, the thinking is if commissions go down, sellers would benefit from lower switching cost. But in terms of how it's all going to play out, it'll be interesting. One thing that we've heard from some of the politicians and some of the media is that buyers are big winners. I'd like to know how you think about it, but I don't really see it that way.
I don't think so. I think who is the big winner in this case? The lawyers, as always. Yeah. The lawyers are going to win everything. But what's going to happen is the multiple listing service is going to just become a mess. I mean, this is a mess. It's going to be so much harder to do business now in the real estate world.
Okay? You're talking about like the hoarding of the listings?
Yes, because now what we're going to see is we're going to see the data, and it's going to make your job harder because the data is now going to get a lot more siloed. And all of these big real estate companies are going to have their own MLSs because you can fix prices in your own company. You just can't talk to your competitors about fixing prices. That's antitrust. That's illegal. And so, what they're going to do is there's going to be, I think, a lot more consolidation in real estate. I think a lot of these smaller brokerages are going to get bought up by bigger brokerages, bigger fish. And the bigger fish are going to have their own MLS systems. So, now as a buyer, you're not going to be able to see everything with one agent anymore. You're going to have to go to Keller Williams to see their stuff. You're going to have to go to RE/MAX to see their stuff. Yes, there will be some cooperation, but there's going to be now a whole lot of friction in that cooperation. And the lenders are going to have to adjust the way they do financing to pay a buyer's agent commission.
Yeah.
So it's going to be a mess. And the net result, I think, and nobody knows yet because none of this goes into effect for a few more months. And even then we won't know because it's going to take a long time to play out. But it's going to be a lot harder to buy a house. That I can say without a doubt. That's just going to make a lot more friction for buyers and buyers agents. And so I mean, look, it's hard enough to buy a house now. I mean, yes, affordability is a problem, but I'm not even addressing that. I'm just saying shopping for a house is hard work. Like that is a lot of work to go shop for a house. It's such a big investment. And if I'm talking about a regular home owner occupant. I'm not talking about an investor. That's easier because it's not emotional. But it's already hard enough to shop for a house, and it just got a lot harder. And so a lot of people are just not going to bother, and they're just going to stay renting. And I think that's going to put upward pressure on rents. That's my view.
Yeah, it'll be interesting to see how it plays out. And it's a tough one because there's a lot of uncertainty. There's still a lot of these legal cases. We don't even know where the DOJ stands on all this, right? Because the thing about that NAR settlement, it's a proposed settlement.
Yeah, right.
And you would think that it would need a regulatory sign off.
Yeah. Well, certainly the court has to sign off on it, and they got to make sure that the class is getting its share. And of course, the law firms are getting their share. Don't you love it, Lance, when you get these notices of, oh, you're in a class action and they're suing, Verizon, and the law firm made $40 million and you get a free phone charger if you ever bother to redeem it, or here's 50 cents. It's like so ridiculous, but that's the world we live in. So yeah, it's going to be just fascinating to see this play out. And I don't know what's going to happen. I could be totally wrong, but I think for sure it's going to be a lot harder to buy a house. It's just going to become a much bigger hassle if the agents can't publish the commissions that they're paying to the cooperating agent anymore.
Yeah, that makes sense. And anything else you want to jump into?
No, Lance, your work is so great. I just want to commend you on all of the great work you do and all of the great stuff you put out. Glad to have you on the show. Thank you for sharing all of this. Go ahead and give out your website.
Yeah, Jason, thank you for having me on. Big fan of your work as well. If people want to read my newsletter, they could go to ResiClubAnalytics.com or just type in Resi Club into Google and you'll find it. There, you just drop in your email and you'll get the weekly newsletter. Each week, I'm, writing about 5 articles for free. Some of them look at new construction, new home price data, just different things going on throughout the residential real estate sector, or maybe some of the markets or counties with the highest rent yields. And then I also have a premium product called Resi Club Pro. It's 3 additional articles a week, very heavy research and data, metropolitan stuff, county, zip code level, and then also my inventory tracker and price tracker as well. If you want to find me on Twitter, they can find me at News Lambert.
Good stuff. Lance Lambert, thank you so much for joining us.
Thanks, Jason.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.